Welcome back to another episode of the Weekly Ticker. My name's Michael. Every week I go over a stock and decide whether it's a buy, sell, or hold. I'm not a financial advisor. I'm just a baby trying to give you financial and investment advice. So take everything with a grain of salt. This week we're going over ORCL, which is a absolute shit show. A lot of danger with this company due to their large amount of loans that they're taking on to try and fund this AI project. So let's jump right into the episode. So for ORCL's products, they primarily focus on creating database software, cloud infrastructure, and enterprise applications. ORCL is best known for their ORCL database. They've done a great job at expanding and creating a very strong product for their customers. They work with banks, governments, and Fortune 500 companies, and they offer this big database so that these companies can take in data, store it in one secured location. They've done a great job at retaining their customers. This product is a subscription, so they get monthly revenue, which shows that they have some fundamental health. Now, that's not the problem. They have revenue, but they're taking on considerable loans to try to fund this AI project. So around October, they announced that they are expanding into AI and the AI data platform. They say they're going to empower customers to innovate in the AI era. ORCL today, that being October, announced the general availability of ORCL AI data platform, a comprehensive platform designed to help customers securely connect industry-leading generative AI models with their enterprise data applications and workflows. They state that they're going to be using NVIDIA GPUs to power this AI platform. So like they said in the beginning, this AI platform enables customers to turn data into intelligence, accelerate innovation across teams, automate and scale business processes, and be enterprise ready from day one. So there's no doubt that expanding into AI was very important for ORCL. All these tech giants are expanding into AI, but they're doing it in a financially healthy way. ORCL is not. I'm going to show that soon. If ORCL didn't expand into AI though, I think that it would create some problems for the company. The only problem is that they're just not doing it healthy. We can see in one very clear picture here, looking at their financial health, we can see how their debt has expanded. And in 2024, they had $108.95 billion in total debt. Their free cash flow is negative. I never invest in companies with negative free cash flow, but in this aspect, this is extremely dangerous. They have so much debt, and their cash and equivalents and their negative free cash flow cannot even cover this debt if need be. Another thing is looking at their assets and liabilities. Looking at their total assets long term, their assets can completely cover their liabilities. But as I'll show with working capital, looking at current assets versus current liabilities, this is starting to raise a lot of concern. So we can see that their working capital, that's taking current assets minus current liabilities, is negative right now. And working capital shows whether or not they can safely expand their operation without financing. This will affect the business, which will then affect the investor. Negative working capital shows a slow payment of bills, poor credit rating, and the ability to turn around or make progress is slim to none, and it creates a lot of problems. If ORCL takes a large downturn, they're not going to really be able to turn around with all this amount of debt, this negative working capital, although their total assets can cover the total liabilities. But at that point, the company is blown to oblivion and investors are hurt very badly. So a big way that ORCL is funding this AI expansion is through bonds, corporate bonds. One of the big issues with this is that they don't really have the best credit rating. They have low investment grade bonds. This does allow investors to get a higher coupon rate, but the event of default is very much more likely. And if they can't pull in bond investors into these bonds, then raising more and more capital to fund their AI expansion is going to be slim to none. But the big thing is not default risk, it is the spread risk. So the spread risk is really talking about ORCL's credit spread wideness relative to U.S. Treasuries. A credit spread is extra yield investors demand to hold ORCL's debt instead of a risk-free treasury with the same maturity. So if this begins to widen, investors are much more likely to go to a much safer bond, whether that be Meta's or Google's or just a U.S. Treasury debt security, rather than going to ORCL's bonds. This again does not allow ORCL to generate a large amount of capital to fund this AI expansion. Due to the widening of the credit spread, ORCL is having to pay out a higher coupon rate to attract these investors, which, like I said, with the interest that they have from loans from banks, now they're having to pay out a higher interest for their bonds, which is again eating into their revenue as well as their free cash flow, which shows why they have such a negative free cash flow right now. So a big thing with these bonds is even if they're done funding the AI expansion, these bonds they have already issued are long term. the interest on these bonds are going to continue to eat away at their cash. And Oracle's debt does create a lot of long-term and current problems. But the main question is whether or not this investment will really pay out. What is the return on investment? Some analysts are bullish and predict strong long-term fundamental growth from this AI build-out. But some are bullish, many are bullish, questioning the pace and economics of Oracle's AI build-out, the high capex spending, the negative free cash flow, and the debt servicing cost, that being interest, that may heavily affect and delay returns or compress margins. This is exactly where I stand on the whole issue. As I've shown from all of the research and data, that this is going to create a lot of problems for Oracle, primarily this interest that they have to pay. And this is going to continue to eat away at their cash. Their fundamentals don't really look that bad though, as I'll show. So we can see from the total revenue here that they actually bring in a good amount of revenue. And every year, they've had a positive year-over-year growth in their revenue. And they're not lagging in their trailing 12 months. They've had a couple upsets, but for the most part, pretty good year. In 2024 and 2023, they had some pretty strong numbers, 8%, 6%, 2022, 17% from the year prior. So, revenue is not the problem, and they're bringing in enough revenue. I just don't think they're bringing in enough revenue to service all of this debt. Another thing that really determines how well their stock price does, as well as the fundamentals, is their earnings per share. We can see that the earnings per share has actually also been growing. Trailing 12 months, they're sitting at 5.32. That's a 22% increase from the year prior. They have had a couple of upsets here as well. Kind of correlates with the revenue. But for the most part, that is also very strong. So they do offer a dividend. The current dividend yield right now is 0.96%. This has been decreasing a little bit year over year. You can see they pay out a dividend per share for the year of $1.70. Now, this seems all fine, but really they are holding on for dear life. They have negative free cash flow. The cash they have should be gone to servicing this debt, retiring the outstanding debt, and holding some type of reserve for all of these bonds that haven't matured yet. Now, from further research, most of their bonds are non-sinking funds. So sinking funds, you hold on a portion of cash to try to retire that debt, that bond over time. That's a lot safer for the investor, a lot less default. But yeah, a lot of them are non-sinking fund. That shows that they're kind of holding on for dear life. But this dividend, I just can't see them holding on to such a strong dividend going forward. Really, their main priority should be servicing this debt and reducing it as well as they can be. And they just haven't been able to do that. One main feature of seeing if they're doing a good job at decreasing their debt is looking at their net debt. Taking their debt and looking at, assets and cash. In this case, they really have not done a great job at reducing this debt at all, and that's not even their main focus right now. But yeah, ever since 2018, they've been slowly increasing their debt. They had a slight decrease from the past year in 2023, negative 1.59%, but in 2024, they're back up to $97.75 billion. So what is my consensus? Well, from all the research that I showed, definitely not a buy, and I would say a sell. I definitely do not warrant any buy position into this company. I'm also not a financial advisor. Once again, I'm just a baby trying to give you financial advice, so take it with a grain of salt. But yeah, I just don't see a high enough return on investment from this AI build-out and all of this debt that they're creating, the loans, the bonds. They're not doing it in a healthy manner, and this will really affect them heavily, fundamentally, long-term, affecting the amount of net profit that they really have. But overall, the decision is up to you as an investor, so do your own research. I hope you enjoyed this episode and learned something new. Drop your opinions down below, and I will catch you in the next episode.